We all know that real estate has created more millionaires than pretty much any other business. The problem is, it's also created a lot of heartaches and bankruptcies. Sure, we can get access to a ton of real estate education on the internet, but that's precisely the problem. How can we tell which strategies will consistently produce asymmetric returns and which should be avoided at all costs? My goal is to give real estate entrepreneurs, capital raisers, and investors all of the secrets so that we can grow our portfolios without dealing with costly investment nightmares. And that's what this program is all about. I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. What is up? Capital Raisers in the building. I am here with Mark and Josh, who are RaiseMasters, and we also have Adam. In fact, Mark just upgraded. He's now a year 3 RaiseMasters, which means he is formally a rainmaker. We're going to get into talking to those guys recently. They had an insane raise and got an incredible price reduction during this economic climate, which is awesome. Before we jump into all that, Adam, how are you?
Hey, doing very well, Hunter. Happy to be here, hanging out with Mark and Josh. And Mark in particular, just watching his growth over the past few years, someone who has definitely been playing at this level, very high level for a long time and continues to impress us over and over again. And if you didn't see the hook for the today's episode, it's a good one. So we'll let them share the numbers here in a moment.
Yeah, that's exactly right. They recently raised, actually, you know what? I'll let you guys say it. So you mentioned the Chateau Deal. Can you tell us the details of that raise and how you guys were able to accomplish that?
Absolutely. So as you all know, very tough environment out there right now. We are still finding deals that work and pencil out, but it's you got to kiss a lot of frogs before you kiss the princess. I mean, it's a numbers game. It's more now than ever, but we still remain prudent to our underwriting principles. But anyways, we found a 425 unit value add, I'll call it a C+ property in Houston, and we raised $22 million in about 21 days. And the secret to that deal, or something that went well in our favor that we had to have go in our favor, was we had $1 million price reduction. And I think, given how crazy the market's been, the way that rates are changing and all that, that really helped fuel that reduction for us. If it wasn't for that, I don't know if we would have gotten it. Yeah, we closed that in May and just started implementing the business plan on that, but super excited to have pulled that one off in such a challenging environment. So feel free to ask questions. I can answer more details on the deal.
I'm looking at Preqin, I'm looking at private equity markets. I can see that most firms are down somewhere between 20 and 40% in their ability to raise capital right now. And there's always talk about, there's all this liquidity. Well, yeah, until there's not. And then it dries up. And then you actually find out who knows how to do this stuff. And so it's really incredible. If you can raise money now, if you can raise $1 now, you can probably raise $2 in 3 years. I've been in this business long enough to know that really is, it's a big difference when it comes to that. So number one, how many investors was that? Because that's a ton of money.
Mm-hmm. Probably close to 120, something like that.
Amazing. Big checks. How did you systematize that capital raising process? Because I know, obviously, dealing with individual investors, 100 investors, you got to get them, to your website, got to get them to submit verification. Can you walk us through some of the processes you use? Because at that level of scale, you have to implement some systems behind the scenes.
Right. That's right. And Mark can speak to this too, but we have a very specific process. And Mark was a huge partner in that deal. He raised a lot of capital with us on that deal, but it's very systematic. And the good news is that, we've been doing this long enough and have a good enough track record that we have a lot of repeat investors. So they're very familiar with how we run things. And so by sticking to the same process every time, they already know what to expect. There's no surprises. Yes, we had some new investors, but for the most part, it was a lot of repeat investors. But our process, we try to keep it simple, stupid. They get we have an automatic email that goes out to the over 1,000 investors that we have. And it's got a link that they can click on to then fill out the paperwork that then automatically gets sent back to us to verify it. And then once that's all done, they can wire the funds in. But it's pretty much the same simple process every time. And it's very automated. So that's how we streamline it.
Love to hear that. And I know, Mark, this is something that you've worked on a lot. And, you've obviously raised quite a bit of money before even working with us. But I think a lot of the effort you've put in with working with us and RaiseMasters has been focused on the automation side of things, or just systematizing things.
And that's a big component of what I still work on. I'm scheduled to talk to my IT guys today, as a matter of fact, about this. It's not just the process of when you're in the deal and collecting the checks and getting the commitments. It's all the pre-launch stuff that, I know I go through, and I'm sure Josh does as well. It's just a lot of preparatory legwork that we go through to let people know, hey, and I got one coming up, get ready. And then, creating that sense of urgency is like don't dither. Do not wait, because it's going to fill fast and you're going to get squeezed out. This one was long enough that I think just about everybody got into the deal that wanted in on this one. But, we've had other deals where it filled so rapidly that we were 2 days later already building a waiting list, and people were mad they didn't get into the deal. And it's like, I don't know what to tell you. Mm-hmm. So, that sense of urgency is a pretty key component of any raise. I don't use it like a cudgel, but, it's always there, and we always remind people.
Okay, let's talk about this real quick, because I feel like, people that have a reputation, if you have nothing to lose, it's easy for me to say, hey, go do this. It's like, all right, I'll try, because who cares? There's nothing to lose. But you guys, purchase hundreds of millions of dollars of real estate. The urgency piece is something that some people are uncomfortable with. Can you talk us through how you balance out that message in an appropriate way, like thinking of it from their perspective, in the sense of you owe it to them to share that urgency? I would love to hear more about that.
Yeah, and I think you just nail it right on the head, Hunter. Like I said, I don't use it as a cudgel, but I owe it to them to let them know what's going on, and that I owe it to them to help them understand that there is, speed is king on this, and you really need to make up your mind. That's why we send out the preparatory emails to sort of start the onboarding process. And if they're on the fence still as we're raising money, well, okay, I'll get you on the next one. But don't come at me 3 days from now when it's full and you just missed the boat. It's not my problem. It is a nuanced kind of, compassionate, kind of beating over the head is make your mind up. And look, they're just conversations. Really, that's all it is. And we're trying to do business together. We offer a good product, good opportunity for you. You seem to want to avail yourself to that opportunity. So, let's speed up this conversation.
Love it. And let me just, for the capital raisers that are out there, you can't over prime the pump, especially when the market is shaky. So if you're going to be doing a deal, or you're going to be making any pivot in your business, let's say you're changing markets, you're changing risk profiles, you're changing asset classes, the time to start to communicate that to your audience is now. It's really yesterday, to get them ready for what's coming up. So if it's lost on you, it's totally normal to not recognize when you hear someone raised $22 million in 21 days, you think, oh my gosh, let me get access to whatever email they sent out. That was just the best email in the world. It's there's a lot more that goes on behind the scenes. Most importantly, background, track record, integrity, but then that buildup of excitement and interest. And also maybe even saying, hey, we passed on this deal. There's no deal. We passed on this deal because the interest rates changed, or we passed on this deal because it didn't meet our criteria. That engages your audience and excites them, so that when you actually do move forward, then you see that type of result. And so we as capital raisers, sometimes we see the result and we go, wow, what a quick fix that could be. It's you got to be dedicated to your messaging of your audience. And if your audience is small, it needs to get bigger, but you still need to focus on messaging to get those people excited for when that moment actually comes. So then you see those success stories where people oversubscribe their deals quickly. I just got a message in Slack for someone that just did that as well for the first time in his business.
This is something you and I have talked about extensively, is your messaging has to have compelling content. It can't just be spam, all right? Because that will get you kicked out of the inbox faster than anything I know. But if you are delivering value to somebody's inbox, they'll want to listen to you. And so in this messaging, just make sure you're always putting good value in there, no matter what it is. You can talk about the interest rate environment. You can talk about the lending environment. You can talk about the real estate environment. Make sure it's a meaningful message. Just don't throw it out there. Just throw anything out there. I see too many people doing that, and that's not how I do it. I've never wanted to do it that way. I think people who I talk to know that I'm pretty serious about this, and pretty stoic in a lot of ways. But when I do put something out there, I've got a reputation of saying something.
Yeah, I can say we've done more messaging now in the past 6 months than we ever have before. Not because we were doing something wrong. I think it's because people are so afraid and scared And the worst thing you can do is just say nothing and pretend that there's not this big white elephant in the room that we're all dealing with between insurance, taxes, skyrocketing interest rates, right? It's real. So the more we can communicate with our investors and say, hey, here's what we're seeing in the market, even if we're not perfect or we're not the best forecasters, we can say, here's what I'm seeing right now. Here's all these deals that we passed on, and here's why they didn't work. But you know what? We got one coming up. Just give us some more time. And here's why. And then when the next one does come, we explain it. They've already, just like you said, Hunter, they've already been primed. They know the landscape that we're dealing with, and they're comfortable with the way that we see the world. So it's not just like, hey, I haven't talked to you in 6 months. By the way, here's a deal, right? And you're right. It's not a magic email. It's several things that have happened to get to the point where they're comfortable. And when the email comes, they're ready to go.
Totally. I love hearing that. So let's talk quickly about the price reduction. It was the kind of thing where there was a moment where a couple of years ago, if you were retrading a deal, it's like you're going to get your reputation tarnished. And then all of a sudden, that was not the case anymore, right? With interest rates rising, there was a lot of more acceptance of, hey, this is not going to work. We're going to lose our earnest money. We're happy to lose our earnest money, but I don't know, you guys are going to find another buyer. Can you walk us through like how, I'm sure there were some discussions internally, maybe even potentially some intense conversations internally. Mm-hmm. How did you go about that conversation? And then how did you get that result for your investors?
Sure. And you're right. There is a taboo around retrades. But the market has definitely shifted. It is not the market it was a year ago or a year and a half ago where sellers were king. It's the other way around now. You find a good solid buyer that can bring money to the table. The power is now in your court. And so retrades are becoming less and less of a taboo. And a lot of it has to do with the fact that we're chasing this runaway trend of interest rates. And every quarter point that rates rise and your resulting interest rate then goes up somewhere around that range, quarter point, your loan proceeds get reduced so much because of the formula that the banks use for giving you the loan proceeds at closing. And so when you're chasing this runaway train and these deals sometimes take 2 months to close, you're trying to forecast a 5 to 7 year deal using data that's changing every day. It's extremely difficult to pinpoint.
Sometimes by the hour.
And so that's kind of what happened here is we're like, look, we told the sellers like, hey, rates are, at that point probably had gone up 75 basis points. And the insurance forecast was not great either because that is also in turmoil. And so we're like, because of this reasons, we broke it up. We broke down the math. Here's where we need to be profitable. If we pay the price that you had, that we agreed to, we're not going to make money on this deal, or it was going to be not what our returns needed to be, right? And we're like, either we do that or we walk away. I mean, it was that simple. And a few days later, they're like, okay, fine, because they got it. And at the same time, they also had a bit of a gun to their head because their loan was coming due. So it's not like they had many options to say, okay, fine, you know what, see you later, I'll find somebody else. Because finding a new buyer, the whole vetting process for a seller of a property that size, I mean, it's not easy. Nice. And so with the gun to their head, our needs, their need to get out, it was just kind of a win-win.
Yep, that's the reality of this market. And so going back to this conversation, like I just want to grab you all and like put you up against the computer and be like, listen to this. This is how you buy deals in today's market. But you've got to focus on your messaging up front so that when it really matters, you can do it. Because this deal, I happen to know, we were talking offline, what this deal is going to do for you, for your company, for your investors. But the moment that you can buy deals that are actually distressed, it's the most difficult to raise the money. That's why the deals are distressed, because all the stuff retreats at the same time.
Quick question for Mark too, a little bit of a segue here. But Mark, I mean, you've been in the real estate sector for probably close to 4 decades now, right? You correct me if I'm wrong. So
yeah, one way or another, right?
Well, I just want to know, what are you seeing anything different now in this recessionary environment than any of the other ones that you've been through?
It seems to be a tale of two cities. I mean, we definitely have this challenging interest rate environment. And at the same time, the economy is still going gangbusters. And, the Fed has got itself up against a wall and is running out of, I won't say that, but, it's becoming tougher for them to just keep raising interest rates because of the disruption they are causing within the economy. And so, I think that the next meeting, they may stand pat. A lot of people are out there trying to read the tea leaves. How that filters down into what we do, I don't know. I think we've got probably another 9 to 12 months of this grind, inflation has come down for 11 straight quarters at this point. The Fed is definitely doing its job. Supply chain is a lot better than it was a year ago. So, we're seeing less inflationary pressure due to that. But then you read the core reports this month, and food prices are up. Gas. We're in that seasonal part of the year where gasoline, is up over $5 a gallon where I live. So it is definitely, a divergent data set that we're looking at. It's just really hard to figure out what the hell to do, candidly. So you just got to be cautious and conservative in your underwriting. And to Josh's point, you got to negotiate with these sellers. And it's like, look, this is what we can do, or we got to walk, and so meet us. Let's get a win-win out of this. I also wanted to point out, we're not the only guys out there that are facing these deals. Josh will tell you, he's submitted a lot of LOIs. And it's still a competitive market out there. There are still folks who are able to do deals just like us. And so we're not winning every deal, but we don't need to. So Josh, you want to speak to that a little bit?
Yeah, I mean, I would say there's still a huge disconnect between what buyers, us coming in, can afford to pay and what sellers are willing to let go of the property for.
Yeah.
What we call the bid-ask spread, right? And the reason for that is because you had some of these guys that have just really high cost basis in these deals because they bought at the peak of the market. And for them not to take a loss or a substantial loss, they have to sell way up here. But then you're looking at the rates of the buyer coming in. It's like, well, I can only make a cash flow here. So how do you cross this gap, right? And that's where we're at. And I think that's what's causing a lot of deals to fail right now or not get transacted. And until there's more stability in the marketplace where rates will stop rising, therefore people can predict further out in the future, I think that problem is going to persist for a while. You're going to find deals that transact are those that cannot recapitalize them and kick the can down the road, so to speak. And they just have no choice but to take pretty significant loss to get out. And again, that's the deal that we transacted on. That was the scenario. I mean, they were going to have to take a loss to get out, but they didn't have a choice. So I see that. I agree with Mark. I think we got another nine or so months of that being the reality of how most deals are getting transacted that are distressed.
Yeah, 100%. Well, that is amazing that you guys took that deal down, and there's nothing like buying right, being in all different economic cycles and everything, but there's the lock in, the feeling of like securing with quality debt, conservative financing, and a quality asset, and just knowing that you got it at a discount. Man, it's good to be back. I know it's going to mean turmoil for people, but like, listen, if you're watching this right now and you're a beginner, holy crap, go all in. That doesn't mean buy every deal. That means go all in on education, get your knowledge up, get your network up. I can tell you starting right now is one of the best times to start in real estate that you're going to find in the last couple decades or the next coming couple decades. It's really, really something, especially now that more people are in this sector, meaning it's more liquid, more buyers, more sellers, more people to transact with, more lenders. I just love this industry for all the right reasons. Okay, Mark, one question before we jump off. Like I said, you recently upgraded to becoming a year 3 rainmaker, which is awesome. There's probably some people watching this right now. It's like, this guy's done a bunch of deals. Why is he in a mastermind? Like, why would he pay for this? For those that are watching this, that are super experienced, that have maybe taken down 100 million, 300 million, $1 billion worth of real estate, what would you say for them that are watching along?
Look, there isn't a day that goes by that I don't feel like I'm drinking from a fire hose. That's the reality of this industry. There's just so much to learn and understand. And, I'm pretty humble when it comes right down to this. And so I always, if I'm going to err any way, it's going to be on the way of second guessing myself and not feeling like there's more data for me to absorb to understand what I'm doing better. It's just a challenging industry because of all the moving parts and all the players that are involved in any one. So why wouldn't I be a part of a mastermind? Helps me.
Dude, it's so true. And it's like, that's why we love it though. You never figure it out, right? It's like a language or jujitsu. It's so great. It's just, you just become a better person in pursuit of doing hard stuff, right? Mm-hmm. And so what does that mean? You're always going to be doing hard stuff, but doing hard stuff makes you a better man, right? Or woman in that case. And it's just the people that attracts. Also, the industry is incredible because the people that we're all here trying to make ourselves better. And it's just this never ending, constantly changing thing that just gets better and better and more difficult at the same time and more competitive. So this has been really a great conversation, guys. Before we jump off, let the listeners know how they can learn more about you, your company, et cetera.
For me, you can go to TPCG Cap. That's Tom, Paul, Charlie, George, Cap is in capital.com. To learn more about us. We're based out of Houston, Texas. Love to chat with you.
And you can go to my website, sgreinvestments.com. That's for Shuler Group Real Equity. And you can just hit me up at mark@sgreinvestments.com.
Thanks a ton, guys. Talk to you soon.